In this video, I want to go over all the topics related to the IRA withdrawal age and essentially go over when is it appropriate time to pull monies from your IRA accounts. What are some common mistakes that are made when somebody's pulling monies from an IRA before the age of 59 and a half? What are some different solutions to some common mistakes, and ultimately help you better your situation to make sure that you could leverage it properly as per your ideal retirement needs and ideal retirement goals. So an IRA is an individual retirement account that somebody could go and leverage a whole slew of different customized options with. So they could leverage investments, utilizing different stocks, bonds, ETFs, mutual funds, whatever the case might be. They could leverage an IRA for annuity contracts if you want to receive some sort of lifetime income stream or some sort of safe accumulation strategy. You could leverage bank-related products, money market accounts, bank CDs. So it's really just a chassis that really depends upon what sort of tax qualification that you have for those monies. So like a common example would be when somebody has a 401k account and they're working for their employer and they know that they're going to retire or they terminate employment, they could go take their old 401k account and roll it over into a traditional IRA. Reason being is the 401k was a qualified retirement account. These are monies that they never paid taxes on. So when they do the rollover, it's just a transfer, but it's known as a rollover into another qualified retirement account, but now it's more on the individual side. So when somebody's looking to take out withdrawals from this IRA account, they want to at least wait till age 59 and a half, or else they could get get dinged with a 10% penalty and get dinged with full taxation off of their monies. So simply put, as an example of, let's say somebody takes a withdrawal out of $1 million because they say, oh, I have all this money here in my IRA. I took all my 401k out, dumped it into did a rollover to my IRA. Let me just take all this money out this year. If they did that, they would get, and let's say they were 58 years old as an example, they would get dinged with a 10% penalty, which would be $100,000, and they would also have to pay full taxation on the monies that they pulled out. So that's a huge, huge problem that unfortunately individuals do sustain because they didn't necessarily know the rules, that there was some sort of minimum requirement with when they could first start accessing their monies. Now, to make matters a little bit trickier, it used to be between a rock and a hard place, or essentially with an IRA, you are in between a rock and a hard place. One is you can't touch your money before age 59 and a half. The other, which used to be age 70 and a half, and this is recently changed by the Secure Act, is now required minimum distributions are at age 72. So what this means is if you're age 72, the government forces you to start pulling out withdrawals from your IRA based upon your age. So at age 72, it's going to be X amount of percentage that you have to pull out off of all of your qualified retirement accounts. If, let's say, you're hit age 73, this percentage off of the total value amount will be higher. Be mindful on how an IRA account grows. An IRA account grows by the contributions that someone's placing into their plan and then the rate of return that they're getting back from their plan. So if somebody's making contributions, all the contributions, let's say this is a traditional IRA, the monies that are going in there, and let's say that they're underneath the specific cap limit of $6,000 or $7,000, based upon what your current age is, those contributions are tax deductible. So simply put, if let's say somebody added $5,000 into their traditional IRA and they made $100,000 that year, they would get a tax deduction of $5,000, so it would show their adjusted gross income as being $95,000 that year. They get a tax deduction. Well, be mindful, the government is not that nice. They're not just going to say, okay, yes, deduct as much money as you want. We never want to see this money again. We're just going to be nice people. No, what's happening is monies are being contributed into this, kind of think of it like a bucket. And then there's a rate of return based upon the different investments and the different customization that you have created within this IRA account. So let's say if you have a combination of stocks and bonds and the rate of return is, keeps receiving gains and gains and gains, this bucket is going to be growing with the power of compound interest. So maybe what would have started when somebody was first, adding contributions into an IRA account or adding contributions into their 401k and they were in their 30s, maybe, this IRA or 401k account was sitting at, $20,000, but now that they're in their 60s, this account could have grown up to $1 million. by the combination of compound interest, contributions, and rate of return that's been skyrocketing during that time. So now the government's licking their chops and they're saying, okay, well, we're not just taxing them on those small contributions that they were making every year. Now we're going to be taxing them on the crop itself, on the overall bucket. So at age 72, when you have a required minimum distribution, the government requires you to start pulling monies out of this account. You have to pull out a minimum distribution out of this account. So the calculation, that percentage is going to be lower at age 72 than at age 73. Age 74 is going to be a little bit higher than age 73. Age 75, because every year you're getting closer and closer to death. So therefore, the government is forcing you to squeeze out further and further and further monies from your overall bucket. So I hope that this concept makes sense. Ultimately, the contributions that somebody's placing into the plan are tax deductible, and you have the power of compound interest, tax deferred growth that's working in there. So therefore, when this bucket is nice and fat, that's why the government, the IRS, has those rules of saying, okay, 59 and a half is going to be the minimum time that you could take it out, and then age 72 is going to be when we're going to start forcing you to take this out. So this is in between, conceptually a rock and a hard place. So I hope that the concept between the minimum age that you could start pulling out withdrawals and the required minimum distribution age where the government forces you to start pulling withdrawals, I hope that both of those make sense. Now, if you have any specific questions regarding this, feel free to call our 1-800 number, 1-800-566-1002, and you could reference this video and speak to a specialist. Now, the next section I want to discuss is laddering withdrawals, because this is a very effective strategy that someone could leverage based upon the age and the year that they want to retire. So what I mean by that is if we understand typical employer-sponsored plans, so I'm going to use 401k as an example, 401k has a slightly different withdrawal age, a minimum withdrawal age, than an IRA. So with an IRA, the minimum withdrawal age is age 59. With the 401k, the minimum withdrawal age is age 55. So if somebody is looking to retire before the age of 59 and a half, there's ways on how they could leave a portion of their dollars in their existing or their old 401k, their old employer 401k plan, or their current employer 401k plan, leave a portion of dollars in there and take out withdrawals from the 401k as it ladders until that age 60 or age 59 and a half marker. At age 59 and a half, that's when they could turn on their spigot from their IRA account. So an example on how this would work is, let's say that somebody is age 57, and after doing some careful analysis, they realize that, okay, if they retire right now, maybe they might be receiving some sort of pension plan from their employer, and they understand what their expenses are, but there's going to be a gap of ultimately $30,000 each year from now until the day that they pass away, off of the difference between what their retirement expenses are and then what their pension income stream that they're receiving. So with this $30,000, let's say if they have $1 million that's sitting in their 401k account, they could go leave, let's say, $100,000 into their 401k, roll over the remaining $900,000, roll that over into one IRA or multiple IRAs that are now serving a specific purpose. Maybe an IRA is set up for income-related needs, maybe one set up for growth-related needs, legacy-related needs, inflation-related needs, emergency-related needs, whatever that case might be. But this portion that's sitting with the $100,000 over here, that portion was held back into that 401k because this person is not quite 59 and a half yet. So their need was to receive distributions of $30,000. At age 57, because we have $100,000 that's sitting in the 401k account, they could pull out $30,000 at age 57, $30,000 at age 58, $30,000 at age 59. This is only equating to $90,000 of their monies of their 401k, as the other $900,000 was now growing and doing, whatever customization that individual wanted it to do. So like the main reason why somebody would take dollars from a 401k account and roll it over into an IRA, and I'm going to go back to this illustration, is really this account value formula. So the way on how a 401k grows is by contributions plus rate of return equals the account value. With a 401k account, an individual is making contributions as per, however much they get paid or whatever their contribution amount is. So let's say somebody's making $100,000 and they're putting away 10% of their salary into a 401k. That's going to add monies into the bucket. And then the 401k also may provide a match. So maybe if if this individual was receiving a 5% match, they would be contributing $10,000 and the company was going to be giving them $5,000. So that means $15,000 was going to go into the contribution for that year. Now, which is fine. Now, when you're no longer working for an employer, that match goes away. There's no more money, and most likely if you're no longer working there and you're deeming yourself retired, you're not going to be adding monies into this 401k for any further. So you have to really eliminate this contribution side of the formula. And now you have to rely on rate of return side. So be mindful of that, because when you go and you're relying on rate of return, 401k plans have limited funding options that are going to determine whether or not it's going to be positive this year or negative this year. So the way on how this rate of return goes by the investment options that you could choose. So the eggs in your basket that you could choose. With a typical 401k plan, you might see anywhere between 10 to maybe 25 different eggs or funds to choose from. So that might be an aggressive fund, that might be a conservative fund, that might be a target date fund, whatever that case might be. This is going to be the typical names of the 401k related funds. With an IRA, you might have anywhere between 5,000 to 6,000 different options. You could leverage different customized IRAs for lifetime income. You could leverage them for safe accumulation. You could leverage, once again, bank products, annuity-related products. You could leverage investment-related products. So you have so many different combinations of eggs in your basket. That's why you have better customization options as opposed to being handcuffed to the 10 to 25 only investment options to choose from when it's sitting in this 401k. So this is why somebody makes that move to go and do the rollover after they stop working for their employer. So if you currently have an old 401k account and you're looking to leverage that into an IRA, obviously, feel free to give us a call and we'll try to explain the different scenarios, the different options available to you. Or just be mindful that, you do have an opportunity to go and if you're trying to get a better rate of return, well, then roll that over into an IRA and manage it yourself. That would give you, more investment options. You could have cheaper cost, higher quality related options than the 10 to 25 eggs in your basket to choose from that you would be subject to in the 401k plan. So once again, if we're using that example, if somebody has $1 million, and they understand that, okay, they need $30,000 a year of income, and this was sitting in an old 401k account, well, they want to leverage based upon what that individual situation is. They might want to leave $100,000 sitting in the 401k account because they're only age 57. They're not age 59 and a half yet. So by doing so, they're able to spit off that $30,000 as it's $900,000 is being customized into individual retirement accounts, a multitude of different IRAs to make sure that that's going to accentuate and really complete what their retirement planning needs, pertain to. So I hope that double example makes sense with how somebody can effectively ladder the withdrawals to make sure that they're not shooting themselves in the foot, pulling out monies from an IRA before they're actually eligible to pull out those monies. So making sure that you're utilizing certain chassis that are acceptable to pull out at that specific duration, at the specific time frame, so that it doesn't penalize you. So a common mistake that's made in this situation when somebody doesn't ladder is they understand, okay, I have a 401k account that's sitting here. Let's say it's that same scenario, it's sitting at $1 million, and an individual automatically assumes that, they can no longer leave their money in their old 401k account. They have to roll it over into an IRA, and they do this at age 57, but they need income from this type of account. Well, when they did the rollover, be mindful that they just made the mistake of utilizing monies that they could have withdrawn after age 55, which this would have been acceptable on, and they just handcuffed themselves to 59 and a half rules because they went into an IRA account. So if somebody took the full $1 million, rolled it over into an IRA, and they tried to pull out a withdrawal this first year at age 57 of $30,000, they'd get dinged with the penalty and they get dinged with full taxation. So that's obviously a problem. So you just want to be very careful, when you're setting this up and avoid the most common mistake, which is, not properly planning, not understanding, kind of the mechanisms to stay underneath the radar in certain situations, and making sure that you're able to leverage your either retirement income play or just retirement planning play, effectively. The other common mistake is individuals outliving their IRA account value balance. And typically where this happens is when they're trying to leverage investments for a play that they should have been leveraging some sort of income strategy. So like that example, let's say if somebody was we'll call them age 60, and they have, they just stopped working and they take the $1 million that was sitting in a 401k account, they roll that over into an IRA. And after doing some budgeting analysis, come to the conclusion that, okay, they need $100,000 of income every single year to the day that they pass away. Well, this might mean, reducing some of their expenses and understanding when those expenses are going to be reduced in the future. So maybe in the first couple of years, they want to, them and their spouse, they want to go travel the world. But then after maybe 5-10 years, they want to reduce that sort of lifestyle. So really having a granular understanding off of what their budget is and what kind of the income is that they could pull off of. And the typical problem that happens is individuals stay in a wealth accumulation mindset when they should have transferred their monies into more customized IRAs for a wealth preservation and distribution type mindset. So what I mean by that is when somebody's working and they're constantly receiving a paycheck and they're constantly saying, okay, I'm just, this money keeps coming in. When they're no longer working, that income is going to stop. Now you have to rely on the assets that you've already accumulated. So that whole mindset, the whole strategy changes. No longer are you trying to just get a return on your money. Now you have to focus in on saying, okay, I want to have a return of my money, not necessarily a return on my money. So I want to make sure that my money is always going to be there for me, that I'm not going to outlive it. Or you don't try to project that, okay, I'm only going to live to age 75, where technological advances might showing you live into your 90s. So that means at age 75, if you exhaust all these dollars, and let's say in this example, you just keep pulling out $100,000 from this $1 million and you don't know how to take a proper distribution strategy, if all things being equal, if let's say there's gains and losses, but it just averages 0% rate of return for those years, all things being equal, you would have outlived this money within 10 years. You would have no more money left. And now this individual might only have to rely on Social Security income if they're not offered a pension plan, or, they might have to downsize that much further. And it's just a huge mess that we see time and time again. So this is, one of those situations. You just want to be very careful as you're pulling out withdrawals that you have a proper IRA withdrawal strategy and you're able to leverage your chips the right way. So maybe if you have an IRA or if you have a Roth IRA, there might be two separate strategies on how to pull those monies out effectively versus if you have non-qualified monies, cash monies, that might be better on a tax allocation strategy, depending upon the age that you should be taking those distributions at. The last common mistake that I have up here is having a portfolio, not a plan. Too often individuals, they just create a portfolio. They just create essentially one bucket, jack of all trades type either product or jack of all trades type account. And when the markets are doing well, they're satisfied. But when the markets start going down, they panic and they don't know what to do. When the markets start going sideways, an individual panics, and they typically panic at the low point. So this is where you could leverage different solutions to make sure that you're having a confident retirement. This is something that we've trademarked. It's known as the Retirement Diet Plan. And I wanted to create something that was a very simple acronym for someone to remember to make sure that they're constantly looking, checking their bases so that they know they're on the right track. The first portion talks about distribution planning. Second one talks about investment/growth planning. The next one talks about estate legacy planning. And then lastly, tax planning. With distribution planning, on that step 1 phase, you want to make sure that whatever your income stream is going to be greater than or equal to what your expenses are throughout retirement. So one of the things that we help individuals, and feel free to give our 1-800 number a call. You can go to our website and set up an online calendar appointment with one of the specialists, just referencing this video, is first off, we want to make sure to see, okay, what are your expenses? What is your current expenses right now? And then what are going to be your retirement expenses? Are those retirement expenses going to change? Is that going to change with healthcare costs? Is that going to change because you're going to be paying off certain debts like a mortgage, other types of ancillary related debts? What exactly is this, expenses to the decimal point, and making sure that we're increasing certain expenses due to inflationary needs, the cost of goods and services increasing year by year versus others that may stay level. After figuring out what this budgeting analysis is, then we look underneath the hood and we say, okay, well, what are some of your guaranteed income sources? Social Security income is going to be, a typical one for an individual or for a family. So you might receive Social Security income, starting at age 62, or let's say somebody wants to retire at age 65. What's the Social Security income going to be? Pension income. Unfortunately, only about 10-15% of individuals are currently offered a pension plan through their employer. So what a pension is, it's a lifetime income stream. It's a defined benefit plan that an individual has access to by working for their employer for X amount of years. There's a calculation that was generated that says, okay, we're going to pay you, similar to Social Security, we're going to pay you a paycheck every month until the day that you pass away. So if, let's say, Social Security income comes in at $30,000, pension income comes in at $30,000, but this individual's expenses, starting at their first retirement year, is going to be $70,000, well, then we understand that there's a gap there of $10,000 in this example. So how do we create an effective distribution strategy based upon what their assets are to make sure that you have some sort of lifetime cash flow that's coming in there to at least suffice this $10,000? So you want to put the smallest amount of dollars and only as much as necessary towards this distribution income related strategy that will suffice this $10,000 need. So in the example, let's say someone has $1 million worth of assets, of non-qualified monies, IRA related monies, which portion of this would produce this $10,000 of income? Maybe this first portion might be an IRA that for $100,000 as an example, that's going to give some sort of cash flow of $10,000. So out of that, this says, okay, now you have hypothetically $900,000 left over to therefore suffice any further gaps that may accrue. Maybe that $100,000 is going to take care of the distribution strategy. So now you can move on to step 2, the investment size growth related need. Do you want to set up monies aside to make sure that you're keeping pace with inflation, so that you might have an ancillary account that's growing to say, okay, anytime the markets are doing well, you could take an extra trip this year, or you could just pay off what that increase of inflationary expenses might grow to. So that's where the investment growth related need comes in. And we use something known as the REEF method to make sure that we understand what your risk tolerance is, where your current accounts are, where your current investment opportunities are, and then does it make sense to go roll it over into a customized IRA to set up specific investments that are going to really match up with your risk tolerance, making sure that you're also reducing fees in the process, so it's alleviating a lot of pressure against your accounts. So that goes by step 1 and step 2. Step 3 is more for the individual, what their preference is, of let's say they want to leave monies after, let's say step 1 and step 2, they've used up $600,000 of their $1 million, and now they have $400,000 left over. Maybe they want to leave this $400,000 as an inheritance, to their beneficiaries, to their kids, to their grandkids, to their spouse. How do you make sure that this is done effectively? Do you set up a will? Do you set up a trust? Do you make sure to leverage, different life insurance to maximize this $400,000 and make that $1 million of tax-free income? So there's different ways on how to arbitrage your monies. And then lastly, making sure that everything is as tax efficient as possible, making sure you're not shooting yourself in the foot. You're not overpaying for taxes where you shouldn't be. You're taking out the proper distributions from IRA accounts that's going to not hinder you on a calculation when you're triggering Social Security income. So there's a lot of different mechanisms in place, but at the end of the day, it's just making sure that you're maximizing your chips the right way, and you're confident with your retirement at the end of the day, so that it's that you never left anything to chance. You don't have that worry. You don't think, okay, I'm going to outlive my monies. You don't have that worry of, okay, I'm too risky in the market, or I'm not risky enough in the market. It's all about precision. It's all about math. It's all about science. And that's how, to make sure you're creating an effective plan, not just a portfolio. So I hope that everything made sense. Once again, if you enjoyed this video, please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Feel free to give us a call at 1-800 number, 1-800-566-1002. The name of this process where you could create different solutions is the Retirement Diet Plan. You could check it out on our website. You could also schedule a calendar appointment through our website as well for a time that works most convenient for you. So when you go to our website, this little calendar will pop up, so it'll allow you to get a effective day and time that works best for you. You can review all this other content, review our other videos, download free reports, and just make sure that you're confident with every little angle, and that we're here to answer any questions that you may have. But once again, I want to thank you for watching this video, and feel free to write a comment, hit the like button, and we'll be sure to send out more content so that educates you guys further and further. Thank you so much.